Welcome everyone to the Getting Started in Real Estate Investing webinar sponsored by lee-chandler. My name is Julie Ye, a finance analyst for the analyst team. Today, I'm joined by my colleagues V. Yakushenko and Daniel Murphy. Please enter your questions into the chat box and hold additional questions to the end. At the end, we will answer questions and allow others to verbally ask their questions. Me and my colleagues will touch on separate portions of the subject for today. I'll speak on how much money do you need to invest in real estate. We will speak on the main steps to get started in real estate investing, and Danny will speak on the advantages in investing in real estate. So how much money do you need to invest in real estate, and how much does it cost to invest in real estate? I will explain the four major expense categories for you. First, the real estate investment purchase, their price, down payment, repairs, and maintenance, and the reserves. So first, let's talk about the purchase price of your first real estate investment. Buy around the median price. If you listed all the homes sold from least to most expensive, the median price is one directly in the middle. Find out the median price of single-family houses in your city. A realtor or quick Google search can tell you this. Do your homework. Once you find a property you like, you will want to do a comparative real estate analysis. You can do that by finding out how much similar properties in the area sold for over the past several months. Ideally, you'll be able to find homes with comparable square footage that are in the same zip code as the property you are considering. Negotiate. Unless you are in a very hot market, it never hurts to make a lower offer. Also, be prepared to walk away from your investment property. You might have to sometimes. Sellers are emotionally attached to their properties and aren't willing to compromise. They also may have an unrealistic idea of what their home is worth, especially if it is just gone on the market. So the next item we're gonna talk about the down payment. As with the purchase price, less is more. The more leverage you have when borrowing to buy your investment property, the less cash out of pocket is needed, and the higher your cash on cash return. The best way to do this is called house hacking. It means getting an owner-occupied loan as low as 3.5% down with FHA instead of a loan meant for real estate investors, usually 10%. But even if house hacking isn't for you, just remember that less money down is usually better, and 10% down is still better than typing up to 20% or more. The third item on our list is estimating repairs and maintenance. Here is where new investors get stuck. You bought your first rental property, but the cash requirements don't stop here. It's still going to take money to maintain the house and keep it in rentable condition. How much this will cost depends on two things. The initial work needed to get it rentable, the average annual maintenance costs. Let's talk about the first one. Is it a fixer-upper? If so, you'll need to factor in a repair budget for items like paint, carpet, counters, cabinets, appliances, anything else needed to make it livable. The second cost to be aware of are the general maintenance costs. Some things you will need to pay for every year, like cleaning the gutters or putting money away towards a new roof when the time comes. These costs aren't urgent, but if you don't take care of them now, then you might find yourself paying more later on, or worse the case, being stuck with a house you can't get rent. The last item to talk about is emergency reserves. It's important to factor in vacations and other unexpected costs when buying a rental property. While some landlords brag about having the same tenants for 13 years, the reality is that that's not always the case. Tenants move out from time to time. Make sure to be conservative. It's much better to overestimate your costs rather than underestimate them. Use this simple breakdown to come up with the right figure for you. Down payment, house hacking with an FHA loan, 3.5%, regular investor loan, 10%, closing costs generally 3.5% of the purchase price, repairs usually 2 per square foot for paint and 4 per square foot for carpet. Anything else gets an estimate, but for rough rule of thumb, figure on 10,000 to 20,000 if it needs cosmetic repairs. Reserves includes 6 months of mortgage payments. So now let's welcome V and listen what is her thoughts about main steps to get started in real estate investing. Hi V.
Thank you, Julie. I'm V, and I will speak on the two main steps to get started on real estate investing. Choose a strategy and pick a target market. The first one is choose a strategy. There are three most popular strategies you can choose. The first one is buy and hold. Owning rental property is where many new investors start. The approach is to acquire and manage residential property for a profit. With buy and hold, you have two options. First, you can either keep your property, maintain it, and possibly wait for its value to go up, or two, you can rent it out for extra money in form of rental income. Most investors choose option number two because you can make money in the short run while building the wealth in the long run. The benefit of this strategy is, can you change the slide, please? The benefit of this strategy is you can make a lot of money in the long run. Regardless of temporary up and down in the housing market, real estate prices are always come back. Natural appreciation will help you build wealth without putting any effort. The next benefit is making money in the short term is always easy because you can start renting out your investment property. The disadvantages of this strategy is you need time to build wealth. So this is a long-term strategy. That means if you are after some quick cash, the buy and hold is not a top option for you. It takes time for sizable natural appreciation to take place. It also requires long-term commitment. This can pose a challenge for beginner investors who might not be sure if they want to engage in real estate in the long run. The next strategy is fix and flip. You buy a property that's undervalued, most often because it's in poor condition, and then you can repair and improve it and sell it for a profit after a few months later. The pros of this strategy is it offers a potential to make large profit quickly, and you also don't need to deal with your tenants. The drawback of this strategy is to be successful in flipping. You need a broad skill set, experience, and access to significant amount of money. Another Another of its advantages is there are many costs you have to worry about, such as the transaction costs, transfer taxes, title research and insurance, closing costs, and agent commission. The last strategy is wholesale properties. Wholesaling Real estate means you find a property for sale below the market value, put it under contract, and then find a buyer. With this strategy, you don't own the property at any point in time. The benefits include you can become a real estate wholesaler with no money, since you don't need to buy any investment property. So this is a perfect strategy for investors with limited budget. It also does not require long-term commitment since you don't have to deal with managing a property or tenants. And also has a potential for much higher gain. So disadvantages is you have to act fast. A wholesaler usually just have a few weeks to find buyers. Otherwise, he or she needs to become the owner. This is one of the most dynamic and risky real estate investment strategies. Fire buyers might turn out harder than you think. So the next step I will talk about is pick a target market. Anywhere or when you decide to invest, do a market research and analysis are always necessary. Having knowledge of the market will benefit you in making decisions. The slide here is a brief summary of how to pick the ideal location for investment properties, including the big picture location criteria and small scale location criteria. So by combining all of these criteria, you can then choose a target investment market. Choosing your target markets will probably begin with a metropolitan statistical area, also known as MSA, which is a larger region. You can then narrow it down further to zip codes, school districts, or census blocks in order to make your property search easier. Next, Daniel will talk about the benefits of investing on real estate investment.
So the first advantage of getting started in real estate investing is cash flow. It becomes a source of passive income from you or for you. And the payments from your tenants can cover initial expenses that you may have had, as well as your throughout your term of owning the property. And the cash flow will increase as you add additional properties, so you can kind of make back your investment and then focus on purchasing additional investments. Additionally, the diversification is another advantage. Real estate has a low correlation to other asset classes such as equity. And with the low correlation, it lowers your overall volatility of your portfolio. Next slide, please. Additionally, the tax benefits are another advantage. You are able to deduct reasonable costs of owning, operating, and managing your property, and rental income is not a subject to self-employment tax. Additionally, you can deduct other things such as your mortgage interest tax, depreciation, cost of repairs, and as well as have a deferral of capital gains. Real estate is also an inflation hedge, with cash flow increasing with the cost of living. As the economy and GDP continues to grow, real estate grows with it. So it's essentially a hedge on inflation. Next slide. Additionally, the appreciation of the asset is another advantage. So over time, it will continue, historically has continued to grow over time, and with that the rent increases and overall gives you a sense of financial security. And now we will be taking any questions.
I have a question. What do you guys think that we should look for in markets? So if someone wants to do one of those strategies, are there any markets you guys suggest that they look for?
Yeah, I can answer that. I think that when looking, kind of going to what is one of the strategies, or towards the end, what V talked about, just looking in an area where you kind of know the area and there's room for growth in the area, whether it's hospitals, schools, colleges, where you'll be able to have tenants. And then also looking further into like the potential job market of the area that you're looking at.
Thank you.
Any questions?
Does anyone have any questions about the type of real estate investing, or which type of real estate investing that they would like to explore further?
So far, I think most clients prefer the duplex and the fourplex, and I think the price is not too expensive and to buy, and if the location is good, and it will easy to rent.
Do you guys foresee anything happening in the near future as far as real estate or real estate prices?
I have a question about that. What you just mentioned, like right now, I know it seems like most homes have appreciated. Like my home that I'm living in, it has increased. Like the comps in the area, they are going for like more than 50,000 more than what it was just like six to 8 months ago. So my concern now is that I'm wanting to get into a fix and flip, but I'm kind of nervous about that just because they're selling for such a high amount now, and I don't know if that's going to sustain like over the next year or so. Does anyone have any insight into that, to what they think will happen?
Yeah, I'll answer that. So Tina, one, that's a great question, because for many markets, there's been a high uptick as far as appreciation. The Indianapolis market, for one, is a market that's been a little slower on that gain. But what I expect to happen in the short term is, as the government releases, or not the government, but as the CDC releases their moratorium on evictions and foreclosures starting January 2nd. If it's not extended, then what will happen more than likely is we'll have a lot more foreclosures that are either going to be in the pre-foreclosure stage or in an auction phase. And once it gets to an auction phase, that is going to affect a lot of the single family properties, because most of those values come from comps. So if you can imagine, let's say in someone's neighborhood where they may have 50 houses, and let's just say that 10% of those houses, so five of those houses end up in foreclosure, or they're foreclosed on, and people are not able to buy those houses at a discount per auction, that in itself will actually compress or drive down the prices. And what that would mean is that those who have recently purchased properties within the last 12 months, at the height of where the prices are now, then they will be underwater. That is my outlook on the short term for real estate, especially for residential within the next 12 months, because I expect that at some point, whether the CDC or the government, they are going to begin to allow foreclosures again.
That makes sense. Yeah, that is one of the things that really concern me. But that does make sense, though. So I guess now, if I was looking to buy a property as a fix and flip, I would really have to analyze it and make sure that I'm getting a really good deal. Because if I'm at the higher end of the price spectrum, I could end up underwater by the time the house has been repaired and ready for sale. Is that what you're thinking?
Yeah. So the Indianapolis market, for most fix and flips, I know it may be advertised as, someone who purchases and renovates and sells, within 90 days. But normally, from what I've seen, we've had people, unfortunately, that will go 6 months or longer with the project. And part of that is some of the older houses are needing are needing substantial work to them, and so in some cases it's more economically friendly for someone to just buy a patch of land and build up from the beginning. It's cheaper. It's cheaper for the materials for a ground up construction than it would be for someone to renovate an existing building. So, you know, let's say something that's closer to downtown, where the houses have a lot more character.
Mm-hmm.
That could be more expensive in the renovation, whereas maybe in a township area or a suburban area where the houses are a little more cookie cutter, that would be cheaper.
Yeah.
The other thing too is something that concerns me in general. In the Midwest, but especially in Indianapolis, we've had a lot of people migrate from California to Indianapolis, and in that transition, a lot of those individuals will then go ahead and buy, you know, property kind of like, you know, at the top of the market. And so the issue is that, and this has happened throughout the U.S., the issue is when someone from outside of a region comes in and buys a property at the top of the market, that local market will then begin to hold firm in wanting a top dollar for, you know, for their properties as well. And that actually ends up pricing out a lot of local homeowners over time. Because, you know, Sam may have sold his property at the top of the market to someone from California, and now Sally wants to do the same thing. And when or if she does also sell her property, then it's going to raise the tide for the rest of the houses in her neighborhood. And so that plays a part in the transition. But the other thing that is interesting to me is if the average purchase price, let's say 5 years ago, was $60,000 for a home, and now all of a sudden the average purchase price for a home is about $250,000 to $300,000. We have to remember that although the price of a house is increasing, the wage of the earners are not increasing.
Right.
So the people who would still, you know, live or occupy those homes, their income has not increased. And for many Americans, income has been stagnant. So it's starting. We're at a cusp right now where it's some of the purchases don't make economic sense. I know on Tuesday, let's see here. Julie, are you there?
Yes.
Okay. Julie, can you go over an example? You don't have to give the address of the property, but can you go over an example that we went over, I think either on Monday and Tuesday in our meeting, and how we were able to decide whether or not what type of cash flow that building would produce?
Well, then before she starts, do you mind me asking, are you in Indianapolis?
I am in Indianapolis, yes.
Oh, okay. Okay, thank you.
Leland, could you repeat your question?
Yes. I think we went over a opportunity in St. Louis. Do you recall that?
Yes.
Okay. You don't have to give the address or anything like that, but do you mind sharing a screen and going over just the mortgage calculator real quick?
Okay, mortgage calculator.
And what we're going to do real quick is one of the things that we look at is trying to figure out if a property, it doesn't matter if it's just a regular house or if it is an apartment building, just trying to see if it will debt service. And what's happening a lot of times, if the idea is to lease or to rent the property, most of the rents are not sufficient enough to go with the purchase price, and so basically the cash flow is like very minimum. And let's see here. So Julie, let's try the one for Quicken, the Quicken mortgage calculator.
That you can touch on the effect of the low interest rate environment also having a pressure or waiting to have to wait about price of homes. I think that the lower the interest rates, the higher the home prices are going to be, because someone shopping, they say that they can have a larger house because the monthly payment is kind of low compared because the interest rates are so low.
So Freddie, one time it was a little choppy on my end, but I think from what I heard, you were saying that because the interest rates are suppressed, that allows people to qualify for more of a home or more of a purchase. Is that right?
Correct. And so that's one of the things I think, another reason why I think we've seen price increases in homes, because, people, if you look at interest rates from a few years ago, they were, above 5%. Now I got an email this morning letting me know that the rates are down to like 2.72 now, which means you can afford more. You take a $60,000 mortgage at 2.72, that's going to be a whole lot cheaper as opposed to being at 6%.
Absolutely, 100%. So there's can someone someone outside of us, can someone outside of Julie and Danny, can someone tell us a market, just a random market that we can look up on Zillow, and we'll use that one as an example.
Baltimore.
Okay, we'll do Baltimore. So Baltimore is different from most areas, but Julie, if you don't mind, can we go to Zillow.com and we'll just type in Baltimore in Maryland?
What is unique about Baltimore?
Oh, okay. So Baltimore is very unique because for about at least a decade or so, Baltimore has been under the prices in Baltimore have been very suppressed.
Okay. All right.
Yeah, Baltimore's been very, very suppressed. And give me 1 second, Julie. I'm gonna find one for you real quick. Yeah, so Baltimore has been very suppressed, but what's interesting with Baltimore is right outside of, I guess you call it Baltimore proper, you'll have the areas there that are booming, and we're talking all of a sudden it's $1 million for something. So I'm gonna copy and paste something here, and this is just a random property that I found. All right, I'm gonna put this in the chat for you. All right, Julie, I put an address in the chat. So the cool thing with Baltimore, one, I have family there, but two, this is an area that, like I said, for the past 10 years, it's been very, very suppressed as far as purchase prices. So the Baltimore area has a lot of appreciation and equity that's available there. They still have people kind of trying to decide whether or not they're going to move there, but ultimately people are going to end up moving back to Baltimore because they're being outpriced in all the other surrounding areas. You have DC, you have the DMV area, or that metro. So all of that metro, Greenbelt, et cetera, those areas, the properties are extremely high, whereas Baltimore, the properties are comparable to where Indianapolis was, maybe 5 years ago. So there's a lot of opportunity in Baltimore right now. But what you would do is we have a purchase price. We'll go ahead and make that. We'll just say that's 190. So we're gonna go to the Quicken Loans tab, the mortgage tab right there, and type that in for our price. We will go to our percentages, and we'll do let's treat it like it's an FHA at 3.5%. And then we'll leave everything else the same for now. So go ahead and hit enter. And it looks like we're paying $1,200. Tap the home price for me real quick, Julie, and then hit enter. I just want to make sure that that home price is the same. tap the percent. So somewhere around $1,200 a month is what we're looking at. Okay, so I want to make sure it was right. All right, so the next thing we'll do is we'll just make another tab and just go to rentometer.com, and hopefully they allow us to do it. All right, here I'll do it on my end too. Give me 1 second. So we go to rentometer.com. Take a bit and bath. Hey Julie, the that property in Baltimore, how many bedrooms are there?
It's a 3-bed.
3
2
bed.
bath.
Okay.
Oh, 3 bed.
All right. So what I did is I went to rentometer.com. I put that exact same address into Rentometer. I put 3-bedroom, all that good stuff. So that it's saying the average rent in that area is $1,521, and the median rent is $1,500. So what that lets me know immediately as an investor with just those 3 tabs, that lets us know that you can't, if you're an investor, you can't buy that property at that 190, because if your mortgage payment is $1,200, that's not including maintenance. We don't know the exact amount for property taxes as of yet, and but these are all estimates for property taxes and insurance. But that lets us know that there's no reason in heck that an investor should even try to purchase a property like that. So what an investor would have to do to even have a substantial amount of return on a monthly basis, that purchase price would have to be lowered by at least, honestly, like $50,000, just for it to be beneficial. So Julie, where it says home price of that 189 on the Quicken Loans, make that home price like 130. So if we're going to pay $1,000 a month and then to lease it out for $1,500, and that $500 a month for cash flow is a lot better. But for most areas, even outside of Baltimore, because Baltimore is actually a decent area, most areas in the U.S. that are not as suppressed as Baltimore's prices, you're seeing a lot of properties that are on the market basically at a break even or that are already underwater. Does that make sense though?
Yeah, that makes sense.
Yes.
So what happens, much like what's the gentleman's name who said that, Freddie, much like what Freddie said, there are a lot of people, because their personal income has not changed and the interest rates have changed, they're able to qualify for a larger property. And they're like, great, this is great. I'm gonna go ahead and buy this house that I always wanted. And it still puts people in a horrible predicament as far as affordability. One of the issues is a lot of loans are government backed, like FHA. Based on someone's credit score, they qualify someone's purchase based on a ratio of their income. So if someone's credit score is a 619 to a 580, they will qualify them for a home based on 33% of their income. If someone's credit is from a 620 to a 649, they're qualified now at 42%. And if someone's credit is from a 650 and up, it qualifies at a 50% of their gross income. But the scary part there is that it's gross income. So your gross income, most people end up paying, if you're working as a W-2 employee, you end up paying somewhere between 30 to 40% in taxes. That includes, Social Security, all the things that come out of someone's check, right? And then if you think about it, if you are leasing a property, that property manager or leasing agent may say, hey, I want you to, I want to see if you can qualify for this property or this home you're renting or leasing if you can pay 3 times the rent. And that's just a fancy way of saying a third or percentile of 33%. So the average American is paying somewhere between 30 to 40% in taxes of their gross. So they don't even get that money. and then they're paying another 30% in their housing. So the average American only ends up with about $30,000, 30% to actually work with as far as living expenses. And so what happens is when the government qualifies them for a loan or a mortgage at 30% or 40% or 50% of their income, they're already kind of having to move money around just to make ends meet, because taxes are taking money, before they even receive it. So it becomes like a catch-22. And that's why, with all that being said, that's why I'm very certain when they lift the moratorium for foreclosures and for evictions, that would be the best time for you to purchase your investment properties. But now would not be the best time to purchase your investment properties. Now would actually be the best time for you to sell any properties that maybe are underperforming, or any properties that you want to sell to maybe gather more equity.
Your hat.
But now would not be the time for anyone to purchase unless you're going to get it at a significant discount.
Okay, that makes sense. Thanks, Leila.
So I'll just answer the first question and answer it. Is it better to own several small houses than big one? The answer is yes, because it diversifies your risk and also makes it easier to sell one and not the whole thing in case you need cash. Some investors' strategy involves buying two houses, buying down the loans for 15 years, then selling one and using the proceeds to pay off the other. In this case, you've got a free and clear house in half the time with cash flow you can live on. Although the equity you own is the same, it's better to own a whole house in 15 years than half a house. The second question?
The second question is, how will I determine the rent to charge for my property? So this is a really important question that every investor should know to answer before they rent out their property. If overestimate, the property can remain vacant for a long time, and if too low, it may result in negative cash flow. So normally, rental property investors typically look for the 1% rule. This means that the monthly rent covers 1% of the acquisition price plus the rehab cost. So for example, if your all-in cost to get the property rent ready is $150,000, your monthly rent should be at least $1,500. Of course, this is just a general calculator. Based on a lot of factors such as location, economic, safety, and crime rate, etc., the numbers can be different.
And for the third question, kind of goes with Leland's first question. I think the best way to maximize the investment is focusing on a market that will generate high returns on investment. So through areas where you'll have tenants, schools are nearby, hospitals are nearby, and there's a good prospective job market in the area. And then also knowing your costs up front, so knowing what your initial cost is going to be and anticipating what your cash flow will be on the property as well.
I'm gonna stop the recording.